talking about the Indian IT landscape. We have now heard from all the large cap IT companies, and the writing on the wall seems to be clear. There is struggle to get growth going, and in some cases, like HCL Tech, there have been project cancellations as well, and the commentary has been a little dire. None of the companies are really guiding for a very sunny FY27. Some, like TCS and Infosys, perhaps, are being more optimistic than others. So where are we at the end of Q4 when it comes to Indian IT? Well, we have Sandip Agarwal joining in, who, of course, tracks money and invests money at Sowilo Investment Managers. Sandip, thank you so much for being with us. Now, I want to put a caveat out there because we know Sandip's overall views, and he's been saying this for months. I remember our earlier discussions in February as well, that this is a big phase of disruption. So don't expect a very swift turnaround in Indian IT and stocks to begin with. Sandip, you still retain that view? Still circumspect of Indian IT in this AI era?
Good morning and thanks for having me on the show. Yes, you are absolutely right. This disruption is at least a 20-25% deflationary in nature in terms of effort. And we have seen that already that, Infosys clearly mentioned that there is a deflation or there is a negative impact on growth because of that. So I think this is a thing which we all acknowledge. We have seen it, and 15 months back when index was at a much higher level, IT index, that since then we are saying that the stocks are not pricing in AI disruption. But I think in last 1 month, what has happened is that if you see now, the index has broadly corrected 35-40%. Few of the stocks have even corrected more, but broadly 30-40% everything has corrected. So when that happens, then the froth in the multiple is gone. And now the industry will be like this, in my view, that we will see 5-6% kind of growth, and there will be a benefit of currency, which was not there in the past. So problem is that many analysts are arguing that currency has weakened sharply in last 10-12 years also, but the companies have not been able to see the margin improvement, which is the case. So I would only like to highlight one point there, that last 10 years there was immense pressure on the industry to increase local talent, and local talent is much more expensive and much lower utilization rates are there. So that part is now dusted behind. So I don't think companies now have any additional pressure other than normal wage hike, which is also come down substantially. So in my view, with 5-6% dollar growth for 3-4 years, along with 6-7% delta on EPS because of rupee, we are talking about 13-14% kind of EPS growth in the industry. And if you are going to see 13-14% kind of EPS growth, the multiple which is there currently is very reasonable. And I think there is at least a 20-30% money at the IT index level which is going to be made. And generally, this resets happen very quickly. So I am constructive from return perspective, but I maintain the view that we are slower growth, lower growth for longer term. That is the thing which we have to keep in mind. This is a mature industry. You will not see very high growth coming back in this industry.
Okay, you've made some very interesting points, Sandeep, and that's a bit of a departure from where we were in February. Obviously, stock prices have changed, so we need to work with that reality. Let me get this right. So what you're saying is that the actual organic growth in dollar or in constant currency terms could be, let's say 4-5%. And you club that with the gains that will come in from the depreciation of the rupee. So therefore, there could be 13-14% EPS growth over the next how many years?
Next 2 years, you should see that, in my view.
Okay. And you find valuations a lot more reasonable. So basically, you're saying that current valuations and say 12-13% EPS growth. So large cap IT stocks are a buy right now, is it?
Yes, so selectively, I will not buy a company where there is a leadership issue. I don't want to call out. I will not buy where there is a proportion of product engineering service or ER&D company. But otherwise, I think the top 2 IT companies don't have either ER&D exposure to a great extent, nor they have any leadership issues, in my view. So those 2 companies look very attractive in my view right now. As I said, that 1.2, 1.3 peg ratio for good management, good board, good margins, good cash flows, and distribution of cash flow. I think it is a very good valuation. So valuation comfort is highest. So I think from that perspective, this sector makes a tactical bet to buy. In the mid cap space also, if you leave aside the ER&D companies, which are very expensive still, in my view, and there is big challenge which will happen there. The IT services, typical IT services, mid-size companies and small size companies are basically at a very, very good valuation. I don't see any challenge there also. So I would say that, from here, 20-30% in next 1 year is possible at the index level of IT, and it is a very good return in the current market scenario. And I reasonably believe that this is possible because 5-6% dollar growth with 7-8% delta each year from rupee depreciation will help a lot. So I think definitely there is a case to buy at index level of IT now.
Very interesting, very, very interesting. So 20 to 30% upside on the IT index. So maybe, I mean, those who don't know what company to pick, you're saying you just buy the index and
Yes.
then kind of keep that as a tactical part of your portfolio. Very, very interesting approach. But tactical aside, now I'm coming to core fundamentals, Sandeep. What was your takeaway after hearing the large cap IT players and the few one or two mid cap companies that have also reported? What was your takeaway in terms of how they're navigating this transition? Look at HCL Tech. And this is not about a stock call right now. I mean, the moment the market heard that contracts are getting cancelled and there is deferment and there is some deflation, you're right, resets happen in a day. The stock collapsed 10% in one session. So what was your
So,
qualitative takeaway
the
from the
qualitative
companies?
takeaway is exactly in line with what we have anticipated. So, if you see any interaction, Surabhi, in last 14-15 months, at least 50-60 times on different channels, I have said that AI is massively disruptive. So people were saying that we have seen
Yeah.
disruption a lot in the past. See, disruption in the past were shifting from one technology to another. There was never a cut in efforts. This is the first disruption where there is a deflation or there is a cut in efforts. You cannot, rule this out that there will be no impact of this. So in my view, definitely there is a 20-30% effort cut. Good part is that we are the least impacted in the whole tech cycle, in my view, because ERP will be the worst impacted, software products will be worst impacted, we will be least impacted because of two reasons. We have contracts which are spread over 5-6 years. So every year, if there is a 30% effort reduction, also whatever comes for renewal, let's say 5 years, 20%. So 20% into 25-30% is also 4-5-6%. So 4-5% deflation, and you can cover that up with obviously 10-12% growth, which I think these companies will be able to do, because you have to remember that we are software factory of the world. That position is not being taken away by anyone. So I am not negative at this valuation. I was very negative on the valuation at which these companies were trading just 14-15 months back. It was insane. The peg ratios were like 7-8 times. So you can't pay 7-8 times peg ratio for an industry which will grow at 5-6-7%. Now the peg ratios are much more reasonable, helped by rupee depreciation also. So we are at 1 to 1.5 times in most of the cases. I think that warrants a good tactical buy. I will still not call this industry as a structural buy or anything. There is no structural buy, nothing. We are mature industry. The markets which we serve completely penetrated. Nothing is there to penetrate further. So I think 5-6% for longer term for large companies and 8-10% for mid-sized company is what we have to work with. And whatever they can do on efficiency improvement, utilization, cost saving, that will be add on the growth. So that is the way I would look at it. I don't see this industry is going to high growth space at all.
Yeah, no, I don't think anyone on the street really is expecting bumper growth to come back. It's just a question of finding out who will navigate this best. So, between the larger names, I mean, how do you rate their efforts and whatever you've heard? Both Infosys and TCS are talking about how they're integrating AI into all of their service offerings, right? And then, these companies have started giving a separate AI revenue as well. So what do you think of that? Then you mentioned ER&D companies. So just give us some pockets which are looking better than the rest within IT.
No, so if you see, Surabhi, from growth perspective, definitely ER&D will do twice the growth rate of IT services over next 8 to 10 years. So obviously ER&D is a better space, but the peg ratios are still 6x. So you have to be very clear when you are buying that what is the price you are paying for the growth. It is not buy at any price kind of market, in my view, and that is the reason we are while growth will be better in ER&D, we are cautious on ER&D companies, and we say that buy go and buy the traditional IT services companies where growth will be lower, but at least the multiples are also very reasonable. So that is the way we are pitching. We are not saying to buy any R&D companies, the ones which are in the auto space or in the product engineering side or ER&D side. I think we should avoid. You can see them simply, the multiples are 40 times, 35, 40, 50 times. You can't buy those stock because growth will be 8-10% or 11%, and even if you take the EPS benefit, it is another 7-8%. So 18-19% EPS growth you can't pay 45 times, 40 times. I think that is very unreasonable. Then you get stuck in those stocks for longer term. So I think right now the best thing to do is to go and buy the traditional IT services companies which are available at 1.2 times PEG ratio, and they will give you 20-30%. I am not saying more, but 20-30% return is possible.
Okay, so large cap IT companies look better than some of the more expensive mid cap ERND stocks. Got that. Overall, and this is at a time, Sandeep, when the Nasdaq continues to hit these new highs. We are Intel soaring 24% overnight on Friday. Globally, I mean, there's no questioning the AI trade. It's still very much on, isn't it?
No, see, the thing is that, the hardware cycle has kicked in after a long, long time. After 2002, 2003, you see in 2021, after 2021, the hardware cycle has come back. So, there was a 20-year pent-up demand, I would say, not exactly of the same hardware, but something else. So, the world was waiting for hardware to come, and this has come because of the AI, the GPUs, and all they have led. I will tell you, there is severe shortage of CPUs, there is severe shortage of memory cards, there is severe shortage of RAM. So many things there is shortage, and I think because of that there is a boom. Now, I think that when what will happen is that after some time this GPU and all those things will mellow down. I think we are in the last leg of that hardware boom, and then there will be some time when the software products, or basically the AI providers like the Microsofts and the who are able to sell those, they will still continue to do well, and that is the reason Nasdaq is moving up. So I think Nasdaq will not fall sharply from here, except whatever brings it down on the GPU side. So the components of Nasdaq, which has the hardware, they will bring it down, but at the same time, the components which are there for selling those, they will do well. For example, the Microsoft should do well, Google should do well. These all will do well. Having said so, beyond a point, you will see some fraud there also after maybe 6 months, 12 months, and then a deep cyclical correction of resetting of the valuation will happen there also, because see, the base is also going up in that case also, and at some point of time the base will make it difficult for them to also post growth. But remember that the Nasdaq components will always have an edge, because see, they have the distribution platform. People always say that the valuations are this, that, and whether they will be able to. If this was not the reason, if you see why YouTube got sold, why so many other companies which were doing phenomenally well, they got sold to this large tech company, because these large tech companies, they can bundle the offerings and sell, so that no one have that capability, and that is the reason these companies are always beneficiary of any disruption.
Got it. So, well, that disruption continues, and the hardware providers are, laughing all the way to the bank, as they say. And let's see how Indian IT services will cope. But for now, Sandeep is saying that tactically, these large stocks look like a good buy. But of course, you need to be nimble and you need to handle them with care and caution. Interesting conversation as always, Sandeep. Thanks so much for joining us. I'm going to remember this one. Feb was a different view, slightly more different, tactical shift now that we're speaking end of April. And I look forward to the next conversation. Thanks so much. Have a fantastic day.
Thank you. Thank you.
All right. Well, that's a view from Sowilo managers. The market is actually looking